Most countries, like the sample here, have functioning, sort of functioning economies which make, trade, and consume goods and services. Tracking the growth of nations seems to be important to numerous financial interests. A method was devised to compile the value of what a country makes. The result, GDP, or gross domestic product, is the market value of all goods and services produced within a country's economy, which is typically reported by month, quarter, and year. Commonly used equation for GDP is the sum of C for consumption, I for investment, G for government purchases, and NX for net exports. Consumption refers to all the goods and services bought by individuals or families, and is typically the largest component of GDP. People use these goods and services and are thus consuming them, even if the good isn't food related. Maybe some goods shouldn't be consumed, but their purchase counts all the same. Goods can be durable or non-durable. Non-durable goods are items like food or gasoline whose usefulness is short-term. Durable goods are items that can be utilized for longer, typically 3 or more years before being replaced, like a car or a fridge. For GDP, another key distinction is that only finished goods are counted. For example, the purchases of a new plane, lawnmower, flamethrower would count as finished goods, while a component, like the engine on the plane, will only have its value counted in the completed product. This avoids double counting, which could disingenuously raise GDP numbers, but thankfully we live in a world where we can always trust the numbers reported by companies and governments. Investment, also referred to as capital expenditures, are fixed assets that are bought with the intent of being held for at least a year. Land, heavy machinery, and buildings that both firms and individuals buy are included. Another common description used is PP&E, plant, property, and equipment. Depreciation is subtracted from PP&E, as the condition of your equipment over time will likely degrade. Business inventories are another component of investment. Rising inventories add to investment, and vice versa. Falling inventories would imply goods are being sold and consumed. One common misconception is that stocks and bonds are counted as investments within GDP. They can be your investments in the saving sense, but they only represent various financial assets, and not capital assets, so they don't count. Government purchases. If worldwide debts and deficits are any indication, governments like to spend money. Be it government-funded roads, healthcare, warfare, welfare, or haircare, the government budget will either directly or indirectly contribute to GDP. This spending is classified as either mandatory or discretionary. This CBO chart shows U.S. government spending for 2018, with Medicare, Medicaid, and Social Security being the major mandatory programs and components of the federal budget. Mandatory programs like Social Security are those that are automatically paid out based on the number of people that qualify for them, meaning that if more people qualify for the program, more money will be made available. These are also transfer programs, meaning the government is only redistributing the money it has taxed or borrowed, and is not buying goods or services itself. Therefore, transfer programs aren't government purchases, but that money would be part of consumption when the recipients of those payments use them to buy things. The other side is discretionary spending, the spending specifically allocated in the annual federal budget, assuming one gets passed. In the US, it's the military, with its men, material, and bases in a wild number of nooks in the world, that is the largest discretionary expense. Some other lesser expenditures include education, scientific research, other R&D, veterans benefits, infrastructure, and the Postal Service. Any of these expenditures for goods or services would be counted as government purchases. One other item of interest is interest on government debt. As it's preferable for a government to not default on their debt, any interest owed is a mandatory expense. A drain on the economy that increases should your debt rise, not that that's a problem for anyone, or interest rates rise, not that that's a problem for most people at the moment. I suppose you could lie about your debt, but people tend to not like that. Or just not pay your debt, but people tend to not like that either. Net exports, or exports minus imports. When a country sells a good or service to another country, the value of the export adds to GDP, whereas the importer who's buying it will see that value subtracted from net exports in GDP. But since these goods are being bought to be consumed, the plus to consumption means consuming imports doesn't affect GDP. Should your exports exceed your imports, as is often the case with countries with a strong manufacturing base like China and Germany, your country runs a trade surplus. Should you import more than you export, you run a trade deficit. Thus the equation C plus I plus G plus NX gives us GDP, but this is an incomplete image of an economy, as some business activities aren't recorded, including illegal activities. Maybe you have the best priced product around, but your government has a hard time blessing the sales of high-end illicit drugs. Therefore, your business is done in the shadow economy or black market, dodging the law and general business taxes and regulation that most follow in the legal and official market or white market. Between black and white is the aptly named gray market, where the businesses in question are not necessarily illegal, but their activity and transactions are not easily tracked and lie outside standard distribution channels. Simple example is when an entity buys up an item in one market and profits off of reselling it in another market where there is a shortage. Pharmaceuticals, game consoles, and college textbooks are some examples where the price disparities between various markets present opportunities for profit. As neither the gray or black markets have any kind of formal monitoring of taxes, they can be taken together as the informal sector, while the white market is the formal sector. Formal sector activity is recorded and therefore factored into GDP, but the informal sector isn't, so GDP would technically be underreported. The spending still contributes to the economy, but the extent can only be guesstimated. Even for those avoiding the law, we ideally want to see the economy grow, unless you have more anarchistic leanings. This graph shows GDP growth reported in nominal and real terms. Nominal GDP is based on current prices, whereas real GDP adjusts for price inflation and deflation by removing it from nominal GDP. While GDP does generally rise over time, falling or negative real GDP growth is a contraction of the economy. If 2 consecutive quarters of negative real GDP are recorded, you have yourself a recession.